you're looking only at best case scenario, you're going to be way too aggressive. You're going to be jumping. People are going to just trying to get a deal. And if you're too conservative, you're never going to get any deal. So there's kind of that sweet spot in between.
We have Bronson Hill. He is a multifamily syndicator and a general partner in about $150 million in multifamily assets. He's also raised over $20 million for those projects and others. He's very passionate about helping investors reduce or eliminate taxes, take advantage of inflation, and grow their passive income.
So I'm excited to be here. I just can't contain it. I've been over here just chomping at the bit to get on this. I'm really excited. Just heard.
This has been one of my more exciting ones. I'm not sure why. Could be the weather outside, but hope you're doing well. These always go quick. You've got a lot of experience in working with multiple different types of operators and talking with a lot of passive investors out there. What should passive investors look for when considering a multifamily syndication?
Yes, I really think there's three things that people should look for. The first and the most important really is the operator. And then it comes to the market, and then it comes to the deal. So, again, if you have an operator that's not a solid operator, they're not experienced, they don't, they don't really have a good track record, you're much less likely to be successful. It doesn't mean you won't be successful. It just means the most important factor in it is who is actually operating that deal and their ability to do it. Then you look at the market. So we look at markets primarily in the Southeast, Texas to Florida. We've bought a couple deals recently in Jacksonville and Atlanta, just areas where the population is just exploding due to people retiring, due to COVID, due to all these things. And as you buy in areas where there's population growth, job growth, income growth, you see it's landlord friendly, you can raise those rents. And then the last thing really comes down to this specific deal. So what is the business plan for the deal? How does that deal look? What are the things that you're trying to actually accomplish? If there's really not a good story, like we're just going to buy it, we're going to raise rents. Well, that's not really necessarily a compelling story, right? You have some sort of value that you're adding to the property because it gives a little bit more margin of safety, which is a term that Warren Buffett uses, the idea that it gives you some sort of safety net in case the market does go down a little bit or something changes in the way that you're looking at that deal or that market.
Yeah, it's a multiple prong approach. From the single family standpoint, because we flipped like 200 or so houses, it was always like all of our best deals were we went in knowing if we were going to flip the property that we could rent it out and a bare minimum break even. And we're at least from a worst case scenario, we're good. Because we could then, if we're able to break even from a rental standpoint, we could probably wholesale it and make a couple bucks too. And then all the deals that really went bad, we didn't follow that strategy. And right. So we had to reassess, or as Ray Dalio talks about, notate that principle and start following it again. So you're talking about having a multiple, telling the story of the property. It's got to make more sense than just increasing rents. So you're doing some other type of value add. What when passive investors are looking at that strategy, what should they really consider for what the operator's plan is? Because you have management, you've got actual physical, aesthetics of the property, and then you've got the financial part of it, all of which are very related. How should they look at that?
Right. So I think there's multiple factors, and they do interchange kind of those three things. You have, the operator, the market, and the deal. So, example of this is just, what has happened with this particular operator recently. We had a deal we bought in Jacksonville in March for $27 million. We just sold it for $37.5 million last month. So 9 or 10 months later, we almost doubled the investor equity. Now we could say, oh, we're really smart. That's really great. It was all our own. We really didn't do a lot, but we bought in the right area. We bought in an area where the population is growing. And if you buy in the right markets, you can do things okay. And
you put yourself in the way of a strong headwind of the market, although you had a good plan as well.
Right. So I think in general, obviously, you can kind of get, in some ways you say you can get lucky, but it's the idea that, I have friends that do stuff in northern markets and I live in LA and other areas, and I don't do deals in these areas just because I don't see the demographic shifts. I don't see the population migration. I don't see the story even kind of making sense for that market. And then when it comes to the specific deal, if you buy in the right area, you're going to be surprised as well about how it performs. We have another deal that we're doing in Florida where it's, we were expecting $200 a month rent bumps and we're getting $350. And how did that happen? Well, some of it's just the area. Some of it's just the way that that's growing. But again, there's got to be a story. It can't just be you're coming in and we're just going to raise rents or something else. Like, no, we're putting this much per unit. We're seeing down the street, or even in renovated units, we're seeing a $200 a month rent bump. And you just want to make sure that when you look at those numbers as a passive investor, that they are conservative, that they're not best case scenario, and they're not worst case scenario. Because again, if you're looking only at best case scenario, you're going to be way too aggressive. You're going to be jumping, and people are going to just trying to get a deal. And if you're too conservative, you're never going to get any deal. So there's kind of that sweet spot in between where it's you're being realistic. You're being, but more on the conservative side of realistic.
Yeah, and having the data to back it up. I mean,
Yeah.
you can't say you're going to raise rents $250.
Right.
You got to actually have the data to back that up. Are there any markets outside of the obvious, Texas and Florida, I include in that, but are there any markets or submarkets that you think folks should look into, or maybe that you haven't, invested in before, but you're strongly considering?
Yeah, I mean, I think, it depends. We work with different operators, so we're not, primarily the operator, the asset manager on these deals. We partner with different operators, but, we've developed a relationship with different folks. I love secondary markets. For example, let's say in Florida, let's say, Orlando and Miami or Tampa they're just exploding. It can be really challenging to find a deal because who are you competing with? You're competing with these big institutional REITs that have billions of dollars that have to put it somewhere. So they've got to go into these big markets. So a market like Jacksonville that's got 1.5 million people, maybe Tallahassee, there are other markets that, may make sense where they're at least, maybe 500,000 people, but not, several million. So, I think it's just really being open to mid-sized markets, things that are not necessarily on the radar. Everybody knows about Dallas. Everybody knows about Miami. Everybody knows about Orlando. But what about the other markets that are maybe a little bit smaller? So, I have some friends doing some stuff in Waco, which looks like an interesting market. But,
Hometown.
Are you from Waco? Okay, so you've seen it.
I don't claim it a lot, but yeah, I am.
Just claimed it now, man. So you gotta.
There you go.
Chip and Joanna Gaines are your best friends. Right?
Yeah. None of that existed when I was there.
Yes, but I think just really, again, looking at, why are people moving here if there's a recession? In Texas, I live in California. In Texas, people kept moving during the Great Recession because it made more sense, because businesses were saying, hey, we're going to keep moving here because it's more landlord friendly, it's more business friendly, and it's cheaper to live. You can pay people less. And so we saw that. We're continuing to see that. And some of these areas, like that's why Texas, Florida, Alabama, Arkansas, Georgia are continuing to grow. So I just think being open to those areas, people like warmer weather, all these retirees, they call it the silver tsunami. They want to live in warm places. So that's one reason I love these areas too.
Yeah, Jay Scott mentioned that long-term horizon versus if you're really, really counting on the 3 to 5 years to hit your targets. That's been happening lately. There's no guarantee that's going to happen for forever. We've got a potential to exit 4 years early in one of our investments. Actually, 2 of them. That's great. I mean, I hope it happens. I'm not really betting on everything happening like that.
Yeah. No, you definitely have to have, different, you have to look at things differently. You have to look and say, what is the long-term goal? And, maybe in 10 years, maybe these areas will not be great. But right now, with the demographics, the way things are shifting, it's just important to have a plan and really look at, all of the 3 of those. It's like, okay, I need to find a group that I like to work with. I'm a passive investor, 1 to 2 groups I like to work with. In what sort of markets do I feel passionate about? They're going to keep growing. And what sort of projects? I think value add projects are way better than Class A or REIT type of stuff because there's no value add. There's no, you own the market. So if it goes up, things go up. But versus with a value add project, you really actually get to take advantage of, adding a lot more value, getting much higher returns.
Yep. Last 30, 60 seconds. Working with a lot of operators, is there anything that they should be, or you make sure that they provide to passive investors, whether it's on the deck or the PPM, to just, the PPM has to be clear, but say the deck and just upfront communication. What do you always recommend that, and how clear they provide certain information? Is there anything that really stands out to you outside of the obvious?
Yeah, I mean, the obvious is the story has to make sense. I think something that's not quite as obvious is just really looking at the values of the operator. I know that's kind of a weird thing, but for us, we try to be conservative. We're looking for transparency. We're looking for a long-term partnership. And those things are very simple, but that's not every operator's goal, right? They're not looking for, they're looking for a one-off deal. They're looking for this. I'm looking for a long-term relationship with people that I trust, that communicate honestly, particularly when things don't go well. Ken McElroy said, you build trust when you deliver bad news early. So you were looking for those type of things when you talk to maybe previous investors with their group, of just really a track record building trust and somebody you can have a long-term relationship with.
Love it. Thank you so much for coming on. Look forward to connecting with you at one of these events coming up.
Awesome. Thanks, Chris. Appreciate you having me.
Absolutely. Take care.